Hello, thank you for agreeing to help me and give me feedback on my talk. I only have 15 minutes to record and the actual talk is 20, so I'll keep it brief and just go through the slides, and if you could just tell me what parts you liked, what I could expand on. This won't be like the actual talk, but a kind of summary version. I'll try to keep, maybe if I keep it to under 10 minutes, that will give me plenty of time to expand and know where to emphasize. So the title of the talk is Why Household Debt Matters. So I want to kind of contextualize in terms of the current debate on whether the UK has a problem debt level. And first, I want to cut into it by saying that basically the current kind of debates within the central bank and within the kind of media about whether we have good levels of credit or bad levels of debt is effectively just confused moralizing. This is the way in which central banks, economists, and policymakers like to act as kind of high priests, giving us strict moral guidance on our financial relationship, which is a debtor must repay their debts. But as with most high priests, we know that this is not a law that is universally applied to all actors in the economy, and it is precisely because it isn't applied equally that it kind of lacks a legitimacy. So instead of going down that route and offering kind of some assessment of whether levels of debt are good or bad, this talk is going to focus on what debt is doing to the economy, but also society. And it sort of draws on a kind of wide body of interdisciplinary and kind of literature on debt and its effects in our contemporary economy. And yeah, from there, I move on to kind of explaining this idea of what a debt economy is, explaining how debt is a driving force of financial-led expansion since the 1980s, namely since the Big Bang in the UK context, but that if we want to understand, we don't have to understand the whole system of finance-led growth. We're just going to start at its source, which is how money is created, and follow that money. So if we start with money is created by commercial banks, you know, as the Bank of England states here quite clearly, banks do not intermediate between savers and borrowers. So anyone who sort of frames lending in that way is using a kind of seriously flawed understanding of banking, contemporary banking. Money is made through debt deposits. So that means that the central bank doesn't control the money supply. It simply absorbs, expands its balance sheet to reflect the amount of lending done by banks. But it does have an effect on the money supply through quantitative easing. So if that is the kind of basic model in everyday life, that means you take a mortgage, the bank says £250,000 mortgage, opens an account, creates £250,000. That's just a fictional asset until you take your income, your present day income, to make interest payments on that loan over time. So £325,000 over 25 or 30 years. So that means £250,000 is created, of money is created in the present day, but £325,000 is taken as present income out of the system back to the banks over time. This buy now, pay later temporal shift is really fundamental to understanding the effects of debt. But the fact that these loans and debt deposits are how money is created is to basically understand the fundamental mechanisms of banking, which is a game of loans. So these debt deposits are originated by banks, then through securitization, they become the feedstock of the global financial system, in which the loans are kind of repackaged, pooled together, sliced, diced, and resold and circulated through the global financial system. You don't have to know all of financialized growth to understand this is the basic mechanism of how it works. However, the current problem that we have in seeing this system, this newly emerged kind of financialized monetary system, is because policymakers cling to highly kind of outdated, confused metaphorical distinctions between the public and the private. So Krugman is the clear authority on this when it comes to debt, but also we've seen how Mazzucato plays with these ideas around public and private in just understanding the role of the state in the economy more generally. So this problem rears its head up again when we're talking about debt. So it's not just that the public-private household are not the same, it's that private debt isn't the same as well. So if we look at the UK banks, we see that they have access to direct bailouts from government. So just a brief look at the figures. 2010, 1,146 billion, 2015, 115 billion. But again, that's in 2015, 7 years after crisis, it's 115 billion of direct public bailout to the banks when the funding gap in the NHS is £5 billion. And the recent disability cuts was 55 million. You know, when people say austerity is a choice, this is the choice. We're penny pinching the NHS and disabled people, but we're writing 115 billion pound check to the banking industry 7 years after it had its crisis. But it's not just that. It's that the Treasury offers an unquantified risk guarantee for the financial system should it fail again. So again is the key word here. I mean, they're planning for the future, right? And finally is quantitative easing. So again, let's look at the figures here. You don't have to know what quantitative easing is exactly, except for it's the central government issuing government bonds that are bought by the central bank. That effectively expands the money supply, as we saw in the previous slide, but 375 billion of assets bought that way. The money supply expanded to buy bank assets, 375 billion, when the NHS is looking for 5 billion. So again, austerity is a choice. But what does this mean when we, in terms of our understanding of debt? Well, all debt is both public and private at the same time. So what we need to understand is that there is a huge stock of debt at the household level in the UK. We can see that quite clearly. Debt, banks are making money, expanding the money supply, and generating profit through this huge buildup of debt. We know that households are unequal. They're unequal income and wealth, but their debt is unequal as well. This debt is distributed unequally through society. So let's look at what this distribution of debt has done to complicate who the winners and losers are, or determine who the winners and losers are in the housing market. So if you were born at a particular time that you had access to cheap housing, the sell-off of council housing, you might have gotten a small mortgage and paid higher interest, but you would have seen that interest rate decline over time. Now, if you instead bought in 2005, you would have paid a lot more for that house. You would have paid for it with a huge debt, but an income that was largely the same as the people who bought, in the 90s and the 80s and the 90s, but just a huge amount of debt. Okay, so that will complicate your ability to make money on or generate wealth through your house over time in a way that people who bought houses in the 80s and 90s will not experience. But it's not just the housing debt, it's also that level above, and the way in which kind of consumer debt is used to kind of pay for every manner of consumption in the household sector. That's cars, white goods, holidays, right down to kind of everyday expenses. But more troubling is the way in which debt is used as a safety net, where reduction in hours or unemployment, rather than going to a welfare, having some sort of income transfer for the state, people are taking out high cost debt. Or worse still, when a family member gets sick, heart attack, cancer, or a new baby is born, or, your mother has a stroke. These kind of one-off emergencies make households borrow because they have no access to government provision. Again, when banks get into trouble, they get 115 billion of state provision to help them through the rough patches. So the important thing to understand is that debt is become integrated into everyday life through this huge expansion of money creation by banks. And we're just now glimpsing how the kind of other regions of the state, like local authorities and higher education, are kind of also being colonized by kind of high cost lending. And we're beginning to see how that will affect them. The important thing to understand about the effect of debt is that it devours our future. Now, what does that mean? This is the buy now, pay later temporal shift of debt. This huge debt overhang that we see, this big stock of debt, it has to be repaid. It has to be repaid over time, but with present day income. And the clearest effect of this is intergenerational inequality in terms of how young people, pretty much everyone under the age of 35, has enormous amounts of debt, especially compared to any other generation. Whereas those who are kind of 55 and over, although some of them, of course, they are unequal as well, but largely speaking, have much less debt, much more wealth. And it's this time lag of debt. So again, let's go back to housing. You bought your council. So a woman who lives near me, she bought her council house for £9,000 in 1989, I think. She's just sold it for £470,000. Okay. So she gets this one-off windfall. Great for her. But it's important to understand that £470,000 is paid for by a huge amount of debt of a younger family who effectively need housing. So her one-off wealth transfer, which again, she might, who knows what happens to that? It has its own wealth generating effects. But what happens when we have a whole generation of people who have now got on the housing ladder with huge amounts of debt? What will happen to them over their life cycle? Okay. They don't just have mortgage debt, they have student debt. They also have consumer debt. What does this amount of debt so early in your prime earning years do to your ability to generate wealth over the life cycle, especially if there is no government provisioning, or much less? And the other issue that we have to look at is the way in which the government has been the merchants of debt in this instance. So one particular group within society who were born at the right time got right to buy. What this generation get is Help to Buy, which is a government-backed loan. One generation got access to publicly subsidized higher education. They got to scale up. They got to benefit from all the earning potential that gave them. This generation, the government gives them loans, and they're meant to take that debt with them before they even begin to work. So again, what is the long-term viability of this system? And I think that this is really the issue that needs to be most addressed in Britain, especially if we understand, in the UK, like in the US, the Corbyn-Saunders phenomenon, in which the young are advocating, looking to a grandfatherly figure to make everything right. We need to ask ourselves how we can find a compromise, an intergenerational compromise, that rather than chasing one generation for votes with triple lock pensions and, tax deductions on housing, wealth extraction, can we look at a compromise, a generational compromise? The next issue is then to kind of look at how debt, how it devours our future, creates a kind of general sense of financial melancholia. So this is about how the debt payment horizons are so long that people, it kind of stifles creativity in the economy. It stifles vitality. It just leads to this more of the same. We only need to look at Japan to see that this can go on for a generation. But also we see the increasing social and personal problems around family breakdown, that's stress, anxiety, that's caused by debt, and without relief, it's just more of the same. What do we do about it? Well, we have to openly acknowledge in the first instance that austerity is a failed experiment. This is, austerity is just the post-financial crash economic strategy of basically downloading all the costs of financial crisis onto households and local communities. This fails because households cannot simultaneously absorb the shock of bank-led debt crisis, as well as being the engines of growth and a balanced recovery. So this is following the OBR figure published last year. And then we end with what can be done about debt. And this is kind of walking through the kind of many tabled policy solutions that aren't really being addressed by policymakers and the media, which is to change the flawed moral economy around bankruptcy, the idea that banks can't go bankrupt, countries can't go bankrupt, people can't go bankrupt, we all must continue to forever pay our debts, and that means that banks have no risk of overlending. This is an important correction, that creditors bear some risk for bad lending. Using debt swaps. So again, if we have a 0.5% interest rate, we should be swapping local authority, high cost local authority and household level debt for cheap government debt paid at lower levels. Straight up debt cancellation, use the example of Wonga and PPI, in which, when odious debts are rather than using Ecuador as an example. So Wonga, PPI, bad debts, you just transfer the money directly to the debtor and call it a day. But, on a kind of systemic level, we either need to start using fiscal stimulus or we need to find a kind of